Welcome back, finance fans. Let us continue this second segment of offerings. Exempt securities. Certain issuers are not required to register their securities with the SEC. For issuers that qualify for an exemption from registration, there are significant time and cost savings. The SEC has determined that the following securities are exempt from the registration and prospectus requirements of the Act of 1933: U.S. government and U.S. government agency securities, municipal securities, securities issued by non-profit organizations, short-term corporate debt instruments with a maximum maturity of 270 days, like commercial paper, securities issued by domestic banks and trust companies, and securities issued by small business investment companies. Although these securities are exempt from the registration and prospectus requirements of the Securities Act of 1933, they remain subject to the Act's anti-fraud provisions. Exempt offerings. In some cases, rather than being based on the issuer or type of security, the exemption from registration is based on how the securities are being offered. Regulation D. Under Regulation D, an issuer's private placement of securities qualifies for an exemption provided the following conditions are met. The issuer has reason to believe that the buyer is a sophisticated investor, meaning an individual experienced enough to evaluate any risks involved. The buyer must have access to the same financial information that would normally be included in a prospectus. This information is provided in the private placement memorandum. The issuer must be assured that the buyer does not intend to make a quick sale of the securities. This is usually accomplished by means of an investment letter, also referred to as a lock-up agreement. The securities are sold to no more than 35 non-accredited investors. Accredited investor. For private placements, there are no restrictions on the number of accredited investors. An accredited investor includes any of the following: financial institutions such as banks, large tax-exempt plans, or private business development companies. Directors, executive officers, or general partners of the issuer. Individuals who meet either one of the following criteria have a net worth of at least $1 million, not including primary residence, or have gross income of at least $200,000 or $300,000 combined with a spouse for each of the past 2 years, with the expectation that this level of income will continue. Restrictive legend. Shares acquired through a private placement carry a restrictive legend printed across the face of the certificate. This legend indicates that the securities have not been registered with the SEC and are not eligible for resale unless the legend is removed. In many cases, the removal of the legend is accomplished under SEC Rule 144. Rule 144. Rule 144 regulates the sale of restricted stock and control or affiliated stock. Restricted stock is unregistered stock typically acquired by an investor through a private placement. Control stock, on the other hand, is registered stock acquired by a control or affiliated person in the secondary market. Control persons may include officers, directors, or other insiders, those with more than 10% ownership, and their respective family members. Any stock acquired by control persons, even if purchased in the open market, must be sold according to Rule 144. Insiders may also have other regulatory requirements that restrict their ability to sell stock. Holding period. Rule 144 imposes certain holding periods on investors. For restricted stock, the purchaser must hold the stock for a specific period before disposing of it. If the issuer is a reporting company, the holding period is 6 months. However, if the issuer is a non-reporting company, the holding period is 1 year. For control stock, there is no mandatory holding period. Filing requirement. Under Rule 144, an investor intending to sell either restricted or control stock must file Form 144 to notify the SEC at the time of placing the sell order with the broker-dealer. If the securities are not sold within 90 days of the notice being filed with the SEC, an amended notice must be submitted. However, SEC notification is not required if the amount of the sale does not exceed 5,000 shares or the dollar amount does not exceed $50,000. Volume limitation. Rule 144 sets a limitation on the amount of stock that an affiliate may sell over any 90-day filing period. For NYSE and NASDAQ-listed stock, the maximum amount that may be sold is the greater of 1% of the total shares outstanding or the stock's average weekly trading volume of the past 4 weeks. For restricted, private placement stock, there is no volume restriction for non-affiliates of the issuer. Non-affiliates are individuals not associated with the issuer. However, volume restrictions continue to apply to insiders and affiliates. For example, if an issuer has 7 million shares outstanding and the average weekly trading volume for the last 4 weeks was 60,000 shares, since 1% of the total shares outstanding is 70,000 shares, and the 4-week average is 60,000 shares, an affiliated holder can sell the greater of these two amounts, which is 70,000 shares. Private investment in public equity, PIPE. Although most private placements occur before the issuer's IPO, a PIPE offering is a private placement that occurs afterward. A broker-dealer assists an issuer by distributing restricted or unregistered securities to a small group of accredited investors, such as hedge funds. These restricted securities are typically purchased at a discount to the issuer's publicly traded stock. Often, PIPE investors hold the restricted securities for a short period and, upon registration, quickly resell them in the public marketplace. Rule 144A. Rule 144A is designed to allow sales of restricted securities to sophisticated investors without being subject to the conditions imposed by Rule 144. Ultimately, Rule 144A creates a more liquid private placement market. The securities offered under Rule 144A may be equity or debt securities and may be offered by either a domestic or foreign issuer. After issuance, these securities may be immediately resold to qualified institutional buyers. Qualified institutional buyers, or QIBs. To be considered a qualified institutional buyer, the entity must satisfy the following 3-part test. First, only certain types of investors are eligible, including insurance companies, registered investment companies and registered investment advisors, small business development companies, private and public pension plans, certain bank trust funds, corporations, partnerships, business trusts, and certain non-profit organizations. Second, the buyer must purchase for its own account or for the account of another QIB. Third, the buyer must own and invest at least $100 million of securities of issuers not affiliated with the buyer. An important note, under no circumstances is an individual considered to be a QIB. Rule 145. Under Rule 145 of the Securities Act of 1933, certain types of securities reclassifications are seen as sales and are subject to the registration and prospectus requirements of the Act. The reclassifications include an issuer substituting one security for another, a merger or consolidation in which the securities of one corporation are exchanged for the securities of another corporation, and a transfer of assets from one corporation to another. However, stock splits, reverse stock splits, and changes in par value are not classified as reclassifications and are therefore not governed by the rule. Rule 147 and 147A. A federal registration exemption is available for securities sold within the borders of one state, provided interstate commerce instruments are not used to sell the securities. If a company is conducting an offering and selling its securities exclusively to its state residents, that offering is exempt from SEC or federal registration. However, the issuer must register the securities in the state where they are being sold. Alright, so under Rule 147, an issuer must meet one of these 4 criteria. First, at least 80% of its consolidated gross revenues should come from operating a business or real property located in the state or territory, or from providing services within that state or territory. Secondly, at least 80% of its consolidated assets need to be located within the state or territory at the end of its most recent semi-annual fiscal period before the first offering of securities under the exemption. Third, at least 80% of the net proceeds from the offering should be intended for use by the issuer, and they must actually be used in connection with operating a business or real property, purchasing real property located in, or providing services within the state or territory. Lastly, a majority of the issuer's employees should be based in the state or territory. Now let's talk about the provisions. The issuer must utilize a reasonable belief standard when determining the residency of the purchaser at the time the securities are sold. This standard is reinforced by the requirement that the issuer obtain a written representation from all purchasers regarding their residency. If the purchaser is a legal entity, like a corporation, partnership, trust, or another form of business organization, residency is defined as the location where the entity has its principal place of business at the time of the sale. Resales to individuals residing outside of the state in which the offering is conducted are restricted for 6 months from the date of the sale by the issuer to the purchaser. This was previously 9 months. A legend requirement applies to inform offerees and purchasers about the resale restriction. Moving on to the primary market for municipal bonds. Even though municipal securities are exempt from the registration and prospectus requirements of the Securities Act of 1933, their underwriting process follows many of the same guidelines as corporate underwritings. The Municipal Securities Rulemaking Board, or MSRB, which is the self-regulatory organization for firms dealing in municipal securities, formulates the relevant rules and regulations for municipal underwritings. It's important to remember that even if a specific security is exempt from registration, the anti-fraud provisions of the Securities Act of 1933 apply to all securities. Issuing general obligation or GO bonds. Since GO bond issues are backed by taxes, both of the following requirements must be met. Voter approval. The issuance of general obligation bonds generally requires voter approval, as the funds generated by taxing citizens are used to repay the debt. The indenture or bond resolution for a general obligation bond typically includes the statutes permitting the issuer to levy taxes. Debt ceiling limitations. A GO issue is usually subject to debt limitations imposed on the municipality by a voter referendum or statutes. Before the bonds can be issued, these legal obligations must be upheld. A municipality cannot issue bonds that exceed its debt limitation, as doing so would surpass its debt ceiling. Issuing revenue bonds. Since revenue bonds are backed by user fees generated by a project or facility rather than by taxes, they do not require voter approval. However, there are specific procedures to follow and requirements to meet before issuing revenue bonds. One of these procedures is conducting a feasibility study. Feasibility study. To determine whether a revenue project will generate the necessary revenues, the municipality must hire a consulting engineer to study the project and present a report. This report assesses the general need for the proposed project and whether it represents a sound economic investment. An accounting firm is typically retained to help determine if the revenues will be adequate to cover expenses and debt service. New issue underwritings. Once a municipal issuer determines the need for a bond issue and has completed the preliminary steps required to offer a bond, such as obtaining voter approval for a general obligation issue, or completing a feasibility study for a revenue issue, it may proceed with the issuance process. To do this, a municipality will typically seek the assistance of an underwriter or investment banker. Selecting an underwriter. In some cases, the issuer appoints its underwriter through a process known as a negotiated sale. Another method involves inviting interested underwriters to submit proposals via a bidding process, referred to as a competitive sale. Municipal advisors. The issuer may also engage the services of a municipal advisor to assist with the offering. Municipal advisors provide guidance to municipal issuers on the structure, timing, and terms of their municipal offerings in exchange for a fee. The firms employing these individuals must be registered with the MSRB. Forming a syndicate. As often seen in corporate offerings, broker-dealers may form a syndicate, with one firm serving as the syndicate manager or lead underwriter. Since municipal issues are typically sold on a firm commitment basis, firms invited to join the syndicate must be financially robust enough to absorb unsold bonds in case of distribution problems. Responsibilities of the syndicate manager, as outlined in Rule G11. The manager generally makes the largest underwriting commitment. Among the manager's responsibilities are tracking all sales and unsold bonds, presiding over the preliminary pricing meeting where members submit their pricing scale, and maintaining records related to syndicate operations. These records include the settlement date with the issuer, allotment of securities and sale prices, and the names of syndicate members along with their percentage of liability. Syndicate letter. For a competitive sale, as the manager forms the syndicate, it invites other firms to participate by sending a syndicate letter that binds all members together. In a negotiated sale, this document is called the agreement among underwriters. Underwriting documentation. The following list outlines some documents that may be utilized during the primary distribution of municipal bonds. Notice of sale. When an issuer intends to sell bonds through a competitive sale, it advertises through a notice of sale. This notice typically contains essential information an underwriter needs to submit a bid, including the offering size, maturity date, coupon rate, and details about the bidding process. Legal opinion. Every municipal issue must be issued with a legal opinion. This legal opinion is drafted by a recognized bond counsel hired by the issuer to affirm the validity and tax-exempt status of the bond issue. Essentially, the legal opinion assures investors that the issuer has the legal authority to issue the bonds. Official statement. The primary client disclosure document used in municipal offerings, both negotiated and competitive, is known as the official statement. This document serves a similar purpose as a prospectus. However, it is not required to be filed with the SEC, since municipal issuers are exempt from the Securities Act of 1933. The official statement provides detailed information about both the issuer and the offering, and if produced, must be distributed to investors. Similar to a prospectus, there are both preliminary and final versions of the official statement. Final official statements must be provided to customers when confirming the trade. There are 15 content items in a typical official statement. 1. Offering terms. 2. Summary statement. 3. Purpose of the issue. 4. Authorization of the bonds. 5. Security of the bonds. 6. Description of the bonds. 7. Description of the issuer. 8. Construction program. 9. Project feasibility. 10. Regulatory matters. 11. Specific provisions of the indenture and/or the resolution. 12. Legal proceedings. 13. Tax status. 14. Continuing disclosure certification. 15. Appendix. Alright, let's dive into the summary of the official statement. Preliminary and final official statements aren't considered advertising since they're prepared by or for the issuer. However, if a municipal securities firm decides to modify an official statement to create a summary or abstract, it then becomes advertising. Because of this change, the summary of an official statement needs to be approved by a municipal securities principal. Next up, we have the Electronic Municipal Market Access, or EMA, and Rule G32. This rule mandates that disclosure documents be filed with the MSRB and provided to customers. EMA acts as the MSRB's data portal where municipal bond underwriters and issuers submit specific documents like official statements. EMA provides free public access to official statements, trade data, credit ratings, educational materials, and more information about the municipal securities market. What's great is that EMA presents this information in a way that's specifically tailored for retail, non-professional investors who might not be well-versed in financial or investing matters. Now, if an official statement has been submitted to EMA, a broker-dealer can send a notice to any customers purchasing a new issue of municipal securities, advising them on how to obtain an official statement from EMA. This process can be used instead of sending a physical copy of the official statement to a customer. However, the notice must clearly state that a copy of the official statement will be provided by the broker-dealer upon request. So, if a customer reaches out to the broker-dealer and asks for a printed copy of an official statement, it must be sent. Assignment of underwriter and obtaining QSIP numbers. In addition to their EMA submission requirements, underwriters are also expected to apply for a QSIP number. QSIP stands for the Committee on Uniform Security Identification Procedures. This 9-digit alphanumeric number is used to identify securities and is assigned to each maturity of a municipal security offering. Now, the application window for a QSIP is as follows. For a negotiated sale, the underwriter must apply no later than when pricing information for the issue is finalized. For a competitive sale, the underwriter must apply immediately after receiving notification of the award from the issuer. And a financial advisor must apply no later than 1 business day after dissemination of a notice of sale. New issue confirmations. Each customer who purchases a new issuance of municipal bonds must be provided with a final confirmation and a copy of the official statement by the settlement date. For a negotiated sale, the following information must be disclosed to the customer either separately or included in the official statement: the amount of the underwriting spread, the amount of any fee received by the broker-dealer for acting as an agent for the issuer, and the initial reoffering price for each maturity in the offering. Conclusion. This concludes the examination of offerings. Once issued, most securities may be freely resold to other investors at the prevailing market price. The following chapters will explore the secondary market in which these securities trade between retail and institutional investors. Trading markets are governed by the Securities Exchange Act of 1934, also known as the 34 Act, and various SRO rules. As we conclude this segment, we invite you to show your support by liking this video and subscribing to our channel. It takes just a simple click for you, but it means significant support for us, and it is entirely free. Please turn on your notifications to be among the first to be introduced to the next segment. Thanks.